Welcome to Capital IQ's 2010 Investor Forum. Thanks for coming to this full day of idea sharing. Many of you joined us here in 2009 for our first Investor Forum. As before, today's forum will address key topics and challenges identified by the investor community. I was trying to figure out how to kick off this session while going through some old emails. One of them was from a friend at a hedge fund. He quoted some lyrics from Eminem, the rapper, to describe potential recommendations to our economic leaders. I was impressed with his application of rap to financial governance and the current economic situation. So I'm going to follow in his footsteps to frame up today's events. Here it goes. Eminem's latest album is called Recovery. It was released in June and hit #1 immediately. His last album was called Relapse, and he was out of work for several years before that. He clearly feels a lot better today, and he feels a lot better about where things are and where they're going than he did over the last 2.5 years. What do you think about where we are and where we're going? We'll hear about that today. The first single off of Eminem's latest album is called Not Afraid. The single hit #1 immediately on release. A few key lines from the song are, "Not afraid to take a stand, everyone come take my hand. Just let you know you're not alone, holla if you feel you've been down the same road." This is what we want to have happen at the forum today. We'd like presenters and participants to take some stands on what's going on in our financial markets and the investor community, to share experiences, ideas, and make connections. It would stretch the metaphor to apply Eminem to all of the topics we're going to discuss today, things like liquidity, risk management, the health of U.S. banks, interest rate policies, the state of our bond market, regulation, although he does have a song called 25 to Life on the album, but hopefully that doesn't apply. I'm still going to use a few more titles from Eminem's Recovery album to describe the environment and our mission at Capital IQ. It's So Bad, track 13, When the Cold Winds Blow, track 1, in our markets. No Love, track 9 from the government. Things Are Going Through Changes, track 6, but maybe not the change that some of us believed in. On Fire and Spacebound, track 10, don't describe average performance in 2010. Given all of this, at Capital IQ, we're not afraid, track 7, and we won't back down, track 4, in our efforts to help you take a stand, to generate better returns with less risk and less work. So thanks for coming. We hope you'll find this forum helpful and the day enjoyable. We look forward to a productive relationship with all of you in the coming year. Thanks again.
Good morning, everyone. My name is Geoff Dolan. I'm part of the client development team here at Capital IQ. And I'm going to be heading up our audience response session this morning. I think there's a really great opportunity for us to get a feel for your thoughts in terms of a variety of topics, issues, and trends. I think we're going to have some fun with this today, and ideally we're going to hopefully spark some healthy debate and maybe even some surprise in terms of some of the range of responses. Just to give some quick context into how it's going to work, you should all have a keypad located either under your seat or on your seat. This is a very straightforward process. Basically, the way this is going to work is I'm going to ask you a series of questions. They're all numerical in form, and it's going to be multiple choice, so basically 1, 2, 3, 4, so on. And basically all you have to do is just enter the number that you think best represents for that particular question. Once you do, it's going to display on the window right there. If you decide to change your mind or want to revote, you basically just need to push another button, and it'll display again, and you'll be locked in. One thing to note is that when it eventually does pop up on the screen here, it's sort of you're locked in with your response. And then another thing just to note as well is that this is completely anonymous, so feel free to be as honest as you like. So we'll get into it. The first question is, what is your forecast for the S&P 500 year-end index level? So the end of 2010, so 2 months, what is your forecast? Number 1 is less than 900, 2 between 900 and 1200, 3 above 1200. So you just hit 1, 2, or 3, and we'll see the results. Okay, so it looks like the majority, maybe our range here was a little broad, but it looks like the majority here fell between the 900 and 1200, understandable with only around 2 months ago before year end. 5%, very bearish out there, so something dramatic would have to occur or you just short the market, and then 38%, a little bullish, so that's good, ideally. And the S&P closed yesterday around 1130 or so not that far to get above 12, okay? So the next question is, what will be the inflationary environment 36 months from now? The first choice is 3 to 8%. Second is 8 to 20%. The third is hyperdeflation. We define that as 20% or more. And the fourth is deflation. So again, it's a good point. So here we go. Okay, so the majority, again, 67%, interesting, is in the 3 to 8%. That's pretty understandable, sort of the status quo, nothing too dramatic changing. 15% in the 8 to 20% range, very few hyperinflationists, but 15% deflation. That's very interesting as well. And this is going to tie in to sort of another question that we have related to gold prices towards the end of the session as well. Okay? So then the next question is a slightly political question. It's going to revolve around what grade would you give the current administration on its economic policy? So effectively, what grade are you going to give Obama and his economic team for their first 2 years of their administration? 1A, 2B, 3C, 4D, 5F. So we'll see how democratic New York is. Maybe. Or not. So we got an F. So the majority, obviously, are in the D and F range, around 61%. Not that surprising. Most of the economic policies are obviously reflecting on Wall Street. So a few A's out there, a few A's and B's, around 20%. So didn't do too badly, but overall, pretty negative sentiment. The next question revolves around is an asset allocation question. Which asset class will perform best over the next 18 months? So you'll see them up there. 1 is cash, 2 is equities, 3 fixed income, 4 real estate, 5 foreign exchange, 6 commodities, 7 natural resources. Okay, so equities, natural resources, and commodities are the top 3. Oh, excuse me, natural resources is number 1, equities 2, commodities 3. So looks like those are the 3 asset classes that folks feel the strongest about in the next 18 months. Worth noting, last year I think the number 1 answer was commodities, number 2 was equities, so things have shifted a little bit towards natural resources. That's definitely interesting. And then cash, real estate, and foreign exchange on the low end. Okay. And then the next question is very topical. Which market is currently the most undervalued? I think we're going to discuss this a little bit further today as well. So 1 would be the United States, 2 would be the United Kingdom, 3 Europe, 4 Japan, 5 Asia ex-Japan, 6 Latin America, 7 Africa, and then 8 other emerging markets. Okay, here we go. And the U.S. is number 1, is the most undervalued. UK the least, and then a nice broad distribution against the rest, anywhere around the 10 to 16%. So it looks like people feel the U.S. is the most undervalued, and then everything else is sort of fair game, I guess, except for the UK in general. Okay. And as I mentioned, we're going to be discussing more about the global marketplace later today, as well as a particular focus on China late in the day. So then the next question is more of a style question. What style ultimately wins 18 months from now? So number 1 is investment managers specializing in fundamental analysis, so pure fundamental stock pickers. The second is investment managers specializing in quantitative analysis. 3 is hybrid quantamental, so that's a blending of both fundamental and quantitative strategy in some capacity. 4 is ETFs. 5 is none of the above. And again, we're going to be discussing both quantitative as well as blending later today also. So the results are 3, hybrid quantum mental, so sort of the best of breeds, best of both worlds, with just strictly fundamental. Coming in at number 2, quants 3, and then ETFs, and be curious what the none of the above is. So like I mentioned, we're going to be discussing this in more detail later today as well. Next question sort of revolves around the recent spike in gold prices over the past couple of years. What is your forecast for end of year 2011, so 14 months out, for gold prices per troy ounce? Number 1 is less than $1,000, 2 between $1,000 and $1,300, 3 between $1,300 and $1,500, and 4 greater than $1,500. Sort of ties in with inflation. So 2, so the answer, the number 1 answer was between $1,300 and $1,500. We hit a high of $1,320 last week on gold. So folks, I think it closed yesterday a little below, around $1,280. So folks think it's going to climb a little bit more, probably with inflation. Then we have some definitely bullish folks out there on gold with above $1,500 by the end of 2011. So definitely interesting as well. And then finally, the last question, relatively straightforward. What do we feel is going to perform the best in the U.S. over the next 36 months? 1 stocks, 2 bonds. Okay. Overwhelmingly on stocks. So people are very bullish on equities, not so much on bonds. Interesting. I guess not that surprising as well. So that sort of concludes the interactive audience response session. Thank you, everyone, for your time.